Welcome back to How to Retire. I am Scott Newhouse, and you are joining us for our 7th episode as we talk about how to invest to and through retirement. Now, if we're going to talk about investing, we've got to start off with Warren Buffett, Berkshire Hathaway CEO, legendary investor, and he has a quote that I think is so true for everyone. We continue to make more money when snoring than when active with our investments. Very important point, especially when we talk about probably the number one thing that you have to avoid when it comes to managing your investment accounts. And the thing that you have to avoid is the quote unquote big mistake. Now, before I get into that big mistake, and you might be able to figure out what it is, but the average investor, just the average ordinary person out there, you and me, consistently gets a lower rate of return for themselves than the investment funds that they own. Let me say that again because it might be a little confusing, but the average investor gets a lower return than the actual funds that they own. Isn't that crazy? And this actually happens in a number of studies. You can look up basically every study that's been done on how individuals behave with their investments show that they mess up their own returns because of mistakes that they make. This is from Morningstar, the Mind the Gap study, and it says, our annual study of dollar-weighted returns finds investors earned about 9.3% per year on the average dollar they invested in mutual funds and ETFs over the 10 years ending on December 31, 2021. This is about 1.7 percentage points less than the total returns their funds generated over that same period. So the average investor gets 1.7% less than the funds that they owned, according to Morningstar. And they say this stems from poorly timed purchases and sales of fund shares, which cost investors nearly 1/6 the return they would have earned if they had simply bought and held. Russell Investments, they have a value of advisor study, and in their study from 1984 until the end of 2020, they found that the average equity investor, stock market investors' inclination to buy high and sell low cost them 2.02% annually in that time period. And they are using the benchmark of the Russell 3000 index, showing on the screen here. So Morningstar had 1.7, Russell has 2%, and then Vanguard's Advisor Alpha study says that Vanguard research and other academic studies have concluded that behavioral coaching may add 1 to 2% in net return. This provides discipline and guidance, and it could be the largest potential value add of the tools available to advisors. So any way you put it, the research shows that the individual investor out there, normal people like you and I, are making mistakes with our investment accounts that's causing us to not even get the average, to not even get the total return that the funds that we own actually receives. And so these are all behavioral mistakes that we own, that we all individually make. What are these mistakes? For some people, it's frequently trading. They're trading multiple times a month or a week, and definitely many times over the course of the year, trying to buy at certain times and sell at certain times based on what they think is going to happen. Some people like to predict what's going to happen in the economy, and they make investment decisions based off of those predictions. That's a very tough game to play that I don't know of anyone who has done that successfully over the long term that's been able to outperform what the market averages. Some people use their political beliefs, left, right, whatever, to influence their investment decisions. They might see Trump in office and they say, oh boy, I can't invest with him in office. Other people might see Biden in office and say, oh, I can't invest with him in office. Historically, that's been a really bad strategy. And also, I made a separate video about this in my podcast, but Republicans tend to do worse when Democrats are in power, and Democrats tend to do worse when Republicans are in power in terms of their investments. And why is that? It's because they dislike the other political party and they don't want to be in the stock market at those times. You've got to put that aside and just not use your political leanings and beliefs to influence your investment decisions. So that's a really big mistake. There's some other mistakes though. Some people have way too much of their money in single stocks, and I've got to tell you, you're not the next Warren Buffett. There's only one of them. That's why he's so successful. You can't do what he is doing with single stocks, so you've really got to limit your exposure exposure to single stocks, and I don't think there's anything wrong with not owning any single stocks and just owning index funds. Another mistake that people make is they don't diversify. They have too much of their money in a specific country or a specific sector like healthcare or technology, or they have too much in one size of company like large size companies. Another mistake that people make is they chase hot investments. Cryptocurrency, I think it's a fraud. I don't think you should invest anything in it. Some people chase hot single stocks. Other people chase, countries that are having a really good economic time, and they think those good times are going to last. It's a really tough game to play if you're going to chase something that's done really well. So I think all of those things are things that you need to avoid doing. And really, it is dependent upon you having good behaviors and good self-control and not making yourself and your family susceptible to these really big mistakes. So our biggest mistake we need to avoid is behavioral mistakes that the person in the mirror is going to make. So that's what we don't want to do. Here's what we actually need to do. The first thing that we need to do is we need to figure out your asset allocation. Simply stated, what percentage of stocks and bonds and other assets do you want to maintain among all of your investment accounts? We also need to be careful about not being too conservative unless you have tons of money. And what I mean by this is if you've done a really good job of saving and you've saved, $300 or $400 or $500,000, you should really be congratulated. That's an awesome amount of money. But you're going to need to have some percentage of your money in stocks so that money is growing over time above inflation, so that there's some money left in your late 70s, 80s, and 90s. I can't tell you what percentage of stocks you need to put in there, but if you're too conservative, if you've got it all in bonds, you've got it all in cash, my worry, without knowing your particulars of your situation, my worry would be that you would run out of money if you have it in something that's way too conservative at your age. So we need to be really careful about that. Another thing that we need to remember, and this goes in with the last point, is that most people need a significant percentage of their investments in stocks. I can't tell you, through this series what that percentage is, but I think you've got to really, think about having maybe more in stocks than you would initially be comfortable with, because we can't go too conservative too quickly in retirement. We also, though, need to be aware of your changing views on risk and how comfortable it's going to sit with you when we go through inevitable market declines. We also need to have eyes wide open that if you are hopefully going to live, 30 to 40 more years, assuming you're in your 60s, you're going to have to go through bad periods. Something like the Great Recession in 2008 doesn't happen every decade, but it happens every, half century or so. So something really cataclysmic, something really bad like that's going to happen. 2022, I'm recording this in 2023. 2022 was a bad year in the stock and in the bond market. Those types of episodes are going to happen. And so we need to make sure that we set up your financial picture so that you're comfortable accommodating that level of risk that you're going to take with your money in the stock market, because we need that growth, but we also need to make sure that you're protected in the short term with enough in your emergency fund, as well as an adequate amount in bonds, which are going to be less susceptible to the ups and downs of the stock market. So there's a lot going on that you need to think about with your asset allocation. Another thing that you need to do is asset location. And we've already talked about this in a previous video, but what investments should go in your taxable accounts, your tax deferred accounts, and your tax-free accounts? We also need to be careful not to create a taxable event unless it's intentional, with something like tax loss harvesting or tax gain harvesting. Another thing that we need to do is remember that if you do asset location the right way, and if you do tax loss harvesting and tax gain harvesting the right way, that's going to give you a better after-tax return than if you were to do nothing. The third thing that we need to do with your investments is make sure that we have good fund selection. So in my mind, what's a good fund? It's low cost. It's well diversified among US and international, among large, medium, and small size companies. We also need to make sure that the company that's putting that fund together is a reputable company. It's a solid company, something that you can depend on, that's been around for a while. Some examples of this, I can't give you any recommendations about which company to use or which, asset allocation to use, because again, that's really up to you and your circumstances. But some really good companies I do like as of now are State Street. Fidelity's got some good low-cost funds. They do have some more expensive funds. iShares is another good company, as is Vanguard. So I really like all four of those companies. Another thing that you need to do with your investments is create some kind of distribution strategy. And questions pertaining to this are, when are you going to take Social Security? Because that's actually going to influence your distribution strategy and how much you're going to take over time. Will you have a pension? That's also going to come into play. Are you going to have any kind of rental income? When are you going to withdraw from your investment accounts? So at what age is it going to make sense for you to do that? What accounts are you going to draw from, and in what order? Are you going to go tap into taxable first and then tax deferred and then you're tax free? Or are you going to go tax deferred and then taxable and then tax free after that? And I've said this in a prior video, but that really is individualized and it's specific to your circumstances, what's best for you and your family. And you need to remember that all of those types of accounts are going to be taxed differently. So there's a lot of moving parts because Social Security is taxed one way, pensions are taxed a different way, rental income's a different way, distributions from taxable, tax deferred, and tax free, those are all taxed differently. So there's a ton going on. If you're not comfortable making this distribution strategy, especially with your taxes in mind, I really do think you need to consider talking to a professional and putting together a good distribution strategy for you there. What else do we need to do with your distribution strategy? We need to figure out how much can you withdraw. So when are you going to distribute it? What accounts are you going to tap first? And then how much are you going to take from those specific accounts? You also need to remember we want to balance taking enough so that you enjoy life today and in your 60s and 70s, but we've also got to make sure that we don't enjoy life so much in our 60s and 70s that there's nothing left over in your 80s and 90s, because that's going to be a really tough situation if you're just living off of Social Security in your 80s and 90s, and it's not something we really want to happen. So we've got to make sure that we're not taking too much, but we're taking enough so that we're enjoying our life right now. There's a few more things that we need to do with your distribution strategy. First, how much can you take from your withdrawals? We've already talked about, what age you're going to take distributions and what accounts you're going to tap into first and second and third. Now we've got to figure out the dollar amount that you're going to take from those accounts. We also need to remember that we need to balance taking enough today so that you enjoy life in your 60s and 70s, but we don't want to take out so much that there's going to be nothing left over in your 80s and 90s. If we are only living off Social Security in your 80s and 90s because we've spent too much in our 60s and 70s, that's going to be a really, really tough situation. I've met and talked to people who are in that situation. It's not fun. And we can't avoid it, but we need to remember that when we do this distribution strategy, it's not set and forget, because if we set it and we forget it and we just keep on going on autopilot without thinking about this distribution strategy and if it's sustainable, then we get into a situation where we run out of money way too early in retirement, and that's really something that we want to avoid. So you got to monitor this. You don't need to look at CNBC every day, but you need to monitor and know what your strategy is, and you need to know when you need to adjust it, both for good, taking out more, and for bad, taking out less. And now let's go through our recap that we have here. The biggest investing mistake is going to come from the person in the mirror, from those behavioral mistakes that all of us are susceptible to. Even great investors like Warren Buffett are susceptible to this, but we have to learn to control ourselves and not to make those really bad investing decisions. That's going to hurt us in the long run. We also have to remember we just want to invest in diversified, low-cost index funds. We're not trying to do anything fancy. We just need a solid rate of return that we can let grow, that we can take out some sustainable distributions, and that's really what we want. We're not trying to be the next Warren Buffett and try and pick stocks that are just going to do much better than the market average. So we know we need to avoid all of those behavioral mistakes. And what do we actually need to do? We need to plan for our asset allocation. We need to plan for our asset location. And then we need to plan for our distribution strategy. I know this is a lot, but I hope you enjoyed it. I hope you picked something out from this video that you can go implement, and I will see you in the next one.